Okay, we're just getting started. Hello, I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. It's all about personal finance, investing, interest rates, the economy, inflation, all of the things that we're talking about that you need to know probably a lot more about. And I'm here to educate you about all of this and share a lot of experiences that I've had personally with the economy, money, et cetera, investing, and that of my clients and how we've all overcome challenges. I think the biggest challenge, though, is not reacting to the just endless drip of news that's been coming out. We had good news, a lot of FOMO, and then bad news and a lot of regret. But if you held steady and didn't veer from your own risk tolerance, your time horizon, your goals, then you're doing okay. You'll come back. You're getting dinged a little bit, but nothing overly out of the ordinary. And that's basically what it is this year for my clients. It's not a great year, but it's not a terrible year either. People keep asking me, "Oh, you must be so busy with the market like this." No, it's not really that busy because of the market. It gets busy because clients have needs that need to be addressed, or they retire, or they want to update their, IRA distributions. That's things like that. The planning, the can can we afford to buy a particular house, a retirement home? Can we put a certain amount down and get a mortgage for the rest? How will that affect our cash flow, our investments, our financial plan? Sometimes people feel like they're behind, so they want to take more risk and they want to know what the ramifications are. We're going to talk about that in a moment, but today I really want to take a look at why why is 2022 such a tough year so far for investors. And I know that it seems obvious. Well, duh, the stock market's in a bear market, right? I mean, I totally I totally get that. Okay, so phone buzzing like crazy. Um, I have kids, so I need to check my phone, when it buzzes. So, you know, why was it so tough to be a diversified investor? I'm not talking about somebody who's just 100% stocks and just threw too much money into the FANG stocks, Facebook, Amazon, Apple, Netflix, Google, and they're just like getting crushed and they don't understand how they could get killed on quality names. That's tech for you. I'm talking about your investor who's using index funds, for example, um, very broadly diversified, and they still took a big hit. Like you're in a 60-40 portfolio, and we have to understand why. So I'm going to roll the quick intro. We're going to get into that. We're going to get a little technical. I'm going to give you five bond fund ETFs, exchange traded funds, that we're going to take a look at to give you an idea of what worked, what didn't work. And I think the big surprise is that uh, the ETFs that invest in TIPS, Treasury Inflation Protected Securities, did not really offer any more protection against higher interest rates than a regular, ordinary, straight out bond fund did. So we're going to roll the intro. This is going to be interesting. It's really important because this affects everybody. If you're an investor, you probably have a bond fund to help mitigate risk and for diversification. So here we go. Okay, thank you so much for joining me. I'm Mitch Goldberg. We're talking about portfolio management, why having a portfolio that includes bonds and bond funds, why that didn't really help a lot of investors and what investors got wrong. We need to make this a learning moment, and we need to understand what exactly impacted bond funds. And we need to take a look at some of the popular ones, and that's what we're going to do. But first, let's talk about investing. Okay, about specifically stocks. Now, I know what I do with my clients' money, and I know that sometimes clients want to get a little bit more aggressive, sometimes a lot more aggressive. They see the bond market, or they see the stock market going up, and they want to get in on the action, or they have stocks, but they want even more juice. They want more upside. So they're like, well, how come we're not in GameStop or AMC, or how come we're not in Bitcoin? How come, we're not just chasing, Marvell Technologies, or so many other really good names, but they're tech stocks. They all, the speculative stuff goes up together and down together. So just because you have 10 speculative investments does not mean you're diversified. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So if you have, hot investments like Bitcoin, Ethereum, AMC, GameStop, a couple of semiconductor stocks, and they're all up, and you're like, wow, this is great, and I have 10 different positions, so I'm diversified. They're up. No, that does not make you diversified. Investments that go up based on the same conditions, like 0% interest rates from the Fed, okay, Fed pumping in liquidity, and just overall a really good market for speculative and aggressive assets, if that's what your investments are going up on, it doesn't mean you're diversified, because all of your investments are acting the same. That's a very different thing than owning 10 different stocks, where one is a drug stock, one is a utility stock, one is an industrial stock, a financial stock, okay, consumer staples, consumer discretionary. Now you're talking diversification. Another way to diversify is to say, well, I'll be in 2 funds. I'll be in the S&P 500 fund. There's so many different index funds that follow the S&P 500, and a bond fund, like a very broadly based bond fund. So you could put 60% of your money in the stock fund, 40% in the bond fund, an appropriate allocation for somebody 55 plus, let's say, a couple of years before retirement, but still need some growth, and you rebalance. So if the 60% stocks goes up to 70%, you rebalance it back down to 60% stock, 40% bonds. That's the math. But most investors are doing that. They're either indexing, or they're investing in broad-based mutual funds, and they're getting exposure between bonds through bond funds, or exchange traded funds, or mutual funds, and stock funds. But something broke along the way, and people are like, I'm down as much as the market. I'm down almost as much as the market, but I have, 30, 40, 50% of my portfolio in bond funds. How could that be? Diversification is not helping me. So that's sort of going to take a look at. Now, I want you to know flat out that I look at investments like tools. I'm having a discussion with clients now about investing for their child, and I'm saying I like the idea of index funds. No muss, no fuss, broad diversification. You don't have to pay a lot of attention to it, and but one of the parents is pushing back and say, well, I could get an index fund. I could get that anywhere. You're a financial advisor, so I want stocks. Like, yeah, I'm a financial advisor. I'm not clairvoyant. I don't have a guarantee for the winning stock. It's not that an index is guaranteed to go up either. But as a financial advisor, it's my job to pick the right tools for the right account and for the right investment objectives and risk tolerance. So to me, the index fund is the right tool. It's not a matter of you could get it somewhere else. I think they get it from somewhere else. It's a matter of, yeah, I'm a financial advisor, so I'm supposed to be advising you on the appropriateness of a particular investment or investments portfolio for you. And if you want to go into all individual stocks, pick 10 stocks for this child's account, that's one way to go. I'm happy to pick them. But I still think you're better off with an index fund for the child, because then, you have to pay attention to it. You don't want to throw money down the drain with individual stocks, and you're putting the money away, after tax money. You're putting it, you're making so much money that you could put away money for your children also. Your life is good that way. But I want to make sure I protect the money, or at least invest it in a way that is prudent. That's what I should say. I want to invest the money prudently. Protecting the money, we could define that in many different ways. Leave it in cash. But what about inflation? Okay, then put it in stocks. But what about risk of loss of principal? Okay, leave it in cash. I mean, you can't avoid every single risk. I mean, there is a risk associated with every single investment choice that you make. You want to be in cash, then you have to worry about inflation. You want to be in stocks, you have to worry about, loss of principal. You want to be in bonds, you have to worry about inflation and rising interest rates. So there's no investment that's without risk. It's just that you need to pick the right investments with risks that you could accept. Big difference. So people were saying to me, "Oh, should I buy Amazon? It's splitting 4-for-1, 20-for-1. Google's splitting 20-for-1." Well, if that's the objective is to own Amazon or Google stock and get a stock split, they of course you should own it. Why do you want to buy it? And usually the answer is, well, I want to make money. Well, that's a different story. If you want to make money, why does it, why does it have to be Google or Amazon just because they're splitting? Let's talk about the kind of risk you want to take, because those stocks are getting crushed this year. So what kind of risk do you want to take? What kind of money do you expect to make? And how long are you willing to wait to make that money? Almost everyone who comes to me says, I'm in it for the long term. But over the short term, when the shit hits the fan, a lot of you are thinking, this is not so comfortable. What happened to the long term thinking? Because you start to think maybe nothing will work in the long term if things are so bad now. It's the mind does that to you. It plays tricks on you. So these are the things you need to talk about. All right, so let's take a look at the at the markets, how things did today. We're going to take it to screen one. Make this a little larger. Okay, larger. Go to screen one. Pop myself up in the corner. Okay, GameStop CFO is leaving the company. Retailer announces layoffs. Well, sure, the stock went up, like 15% because it's doing, GameStop because it's doing a 4-for-1 split. But who cares? It's like if I took a scoop of chocolate ice cream, put it in a bowl, and said, here's your chocolate ice cream, and you want chocolate ice cream, you're happy. Now, if I cut the scoop into quarters and put the quarters into the bowl, like not touching, but right next to each other, do you have more ice cream? No. It'll be something that you'll probably eat in 4 bites, but that's what stock splits. That's how stock splits make sense. It's like you don't have more. You have the same. You don't have less either. You have the same. I just still don't get it why stocks go up on a stock split. Maybe it's just people think it's such a bullish thing for a company to announce a stock split. Usually a company announces a stock split after it's gone up a lot. So the feelings about it are pretty good from investors. And that could be expected to continue. That I'll give you that, but it's definitely psychological. Okay. All right, let's go. Dow up 346 points. Nasdaq, this is a big day, up to over 2%, and the Nasdaq 259 points. Big day in the S&P, up 57. Gold in the 1700s, big deal. Oil rebounded a little bit, nothing major. 10-year yield closed above 3%. And the VIX was off a little bit, down to 26. Yeah, that's a good thing. That is a good thing. When the VIX goes down, usually it means the stock market's getting ready to rally. All right, we talked about the VIX recently, so we could talk about that more if you want. Okay, it's your show, so think about it like this: it's your show. Ask me whatever you want. Hashtag AMA. And while you're watching, there's nothing wrong with asking me a question in the comments. Hey, Mitch, what do you think of this? Why is this? What happened here? Ask me a question in the comments. I love hearing from you. It's the best part of doing this live stream. And while you're watching, if you don't mind, give me a thumbs up, a heart, or a wow, or an applause. Whatever reactions are available to you, depending on which social media platform you're watching on. But let's take it to the bond market. The 2-year is at 3.02. The 10-year, now it says 2.998. So it's still an inverted yield curve, but now it says 3. See, that keeps bouncing around a little bit. It's trading after market. So still a slightly inverted yield curve, but yields are up across the spectrum with the exception of the shortest of short rates, the 1-month T-bill. I don't really read anything into that at all. And now I want to take a look at some of the bond ETFs and that you should know about. There's a really good chance that if you are an investor, there's a really high probability that you are going to have at least one of the bond funds that I'm talking about. By the way, guys, thumbs up, hit the thumbs up. Just give it a tap. Like just you're watching on your cell phone like that. Just you do this. You just tap the thumbs up, just like that. You tap it, and I get to see who's watching, and then your friends will see the show because it'll start to pass. The algorithm will pick it up and start to spread out the show to more people. Look, I sponsor the show myself, so it's without viewers, it's I would still do the show without any viewers. I have a lot of viewers. A lot of you are watching. Getting probably a couple of hundred a day now, sometimes more. But let's look at the bond funds. Okay. First one I want to look at is BSV. This is a big short-term bond fund from Vanguard, very popular fund. I just want to show you the year-to-date. Year-to-date, it's down 5%. So aren't short-term bond funds supposed to protect you or help you or go up while the market goes down? Well, interest rates are already so low that they had no place to go but up, which is not good for bond funds or bond prices in general. So that's down 5%. Now let's take a look at BND. I think this is the biggest bond fund, the Vanguard Total Bond Market Index Fund. It is the biggest. This is the ETF. This is down year to date. Okay. It's down a lot. Down 13%. Down 13%. You're like, but it's a bond fund. I thought bond funds are supposed to be safe. I'm not even supposed to use the word safe. I'm supposed to use the words like potentially more stable. Okay. But nonetheless, this has been one of the worst years so far ever in the history of markets for bonds. Okay. So that one's down 13%. So let's look at another one. Okay. Let's look at tips. This is from iShares. Okay. iShares Tips Bond ETF. This is a super popular tips fund. Tips means Treasury Inflation Protected Securities. So as the bond prices go down, the prices are adjusted to help investors maintain their value of their bond funds, of their bonds, when there's inflation. So there's been a lot of inflation. So tips should be adjusting and everybody should be happy. But don't worry about the graph. Let's just get down here. So how'd the tips do? Down 12% on the year. Almost as bad as the general bond fund. So what the hell's the point of owning tips if they're not going to help you? So tips did really, really poorly. Treasury Inflation Protected Securities. This is TIP, TIPS is a symbol. This is the big bond fund from iShares. Okay. So let's continue. Let's look at MEAR, MEAR. A lot of people consider this as close to a money market without being a money market, but no, it's not a money market. Okay, it's a short-term, short maturity. I don't mean shorting. I mean like short-term maturity municipal bond ETF. How'd this one do? Don't forget the chart for a second. Okay, year to date, barely down 0.76. Nothing to complain about compared to other bond funds, and especially compared to stocks. It's not a fair comparison to stocks because bonds are bonds and stocks are stocks. So we want apples to apples comparison. So in an apples to apples comparison against other bond funds that we're looking at today, this one held up extremely well. Off a tiny bit because it's very ultra short-term duration, meaning it is very short-term bonds and it's not as sensitive to fluctuations in interest rates. So this is holding up okay, and nothing wrong with it. Dividend is barely there, but at least it's holding up. Okay, not quite enough to pay. The dividend is not enough to pay for how much it's down, but still it's barely down on the year. Okay, and the last one I want to look at is Float, FLOT. This is the iShares floating rate bond fund. It's a really, in this space, this is, I think it's the biggest one. So FLOT means it invests in bonds whose interest rates can fluctuate or can adjust according to external changes in interest rates and inflation. And how this one do? It's down 1.62% on the year. This is the floating rate fund. So what does it tell you? It tells you that bonds have not been a place to hide in. It tells you that you take your typical, 65-year-old plus investor, and there's, who would typically have these bond ETFs or similar bond funds to what I'm showing you now. They're scratching their head saying, how come I'm getting killed? I know the market's down a lot, but wasn't the bond portion of my portfolio supposed to help me? No, not this year. So this is why it's been a really tough year. I'm not feeling sorry for those who got too hard into stocks and FOMO stocks and pandemic stocks and meme stocks. You took your chances. You lost probably permanently for a lot of you. But for your diversified investor saving for retirement, for the kids' college education, you could see why diversification is not really helping a lot when bond funds are doing so badly in a year. Now, this is all subject to change, and maybe we'll see a change the second half of this year. But right now, this year is one of the worst years on record ever for the bond market in terms of performance of bond funds and bonds individually as well. All right. So you should just know why. All right. Now, I hope you do. Okay. So that's my show for today. I can't believe it's Thursday already. So, I usually don't do the show on Fridays unless something really funky happens. And unless we have like a really big down day in the market tomorrow, I'm not going to be on air. Tomorrow morning, we see the non-farm payroll figures come out from the Department of Labor. Those are very, very important and are the most important gauge of the health of the economy. So a lot of people are thinking it could be a weak number because the economy has gotten so much weaker in the last month and a half. But pundits are expecting about 250,000 to 350,000 new jobs created. We'll see, or we'll see what happens. Maybe we'll get a negative print. All right. I'm going to be back Monday, faux show, and have a great night. Thank you.